Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenter, a few quick reminders as always. Everyone that is registered for today's program will receive a copy by early next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today, we welcome back our good friend, Charlie Chesbrough, Senior Economist at Cox Automotive. Charlie, I know you have a lot of updates and information to share with us, so take it away.
All right. Well, thank you, Rachel, and thank you to everybody for joining us today. We're going to give you the automotive market update today, give you another status update as to what we're seeing out there in the market. We're going to start by just talking about the virus itself and the U.S. economy. And I'll take you through a few of the surveys that we've done with consumers, just to give you a little insight as to what we're hearing from buyers themselves as well as dealers. And then finally, I'll take you through some of the slides, give you an update on what we're seeing in the new and used market. A lot of moving parts. Things are still looking fairly strong out there, but we are concerned about where things are headed going into this fourth quarter. But let's start by talking about the virus. And here's a map of the country as to where we're seeing infection rates. This is something we monitor at Cox Automotive by county around the country. We highlight where we think the virus problem is more severe relative to other places. And you can see it's still widespread around the country. We are starting to see growth of virus cases in the northern part of the country around North Dakota, South Dakota, Minnesota, Wisconsin. All of them are starting to get a little bit more severe. At this point, we've had 7.6 million cases and 212,000 deaths. And we had, I think, 37 states have reported more cases this week than they had last week. So we are still battling this pandemic. And at this point, I think we have to say that it's going to be with us for quite some time, and certainly is going to be having implications for the economy going forward. And so I don't know what more we can say about it other than it's just become part of our life, and we're all going to have to adjust to it over the next couple of years, I'm afraid. But here's what the impact's been on the U.S. economy. And I left in the historical data just so you can get some idea of perspective. This is showing quarterly economic growth going back since 2000, and look at what happened here of what we saw in the second quarter of this year. The first quarter, just that month of March alone, took the economy down at 5%, and then down 31% in the second quarter. We are expecting to see some strong quarter-over-quarter growth numbers this quarter, so things are going to start to look better numerically, but there's still a major problem out there in the economy, and that's regards to employment. And we are still dealing with an employment situation that's very, very difficult. And this is showing the unemployment rate for the U3 as well as the U6, which includes sort of the underemployed or folks that are working part-time jobs. And essentially, most folks look at the U3. That's looking at almost 8%. We've come down from that spike that we saw in the early days of the pandemic. It's all heading in the right direction, but we are still shedding jobs in the economy. We've seen a lot of companies that did temporary layoffs have rehired people. Everything is moving in the right direction, but we are starting to see now that unemployment is ticking up again, at least in terms of new initial claims. And in fact, we got a number out today of initial claims, more this week than last week, which suggests at 800,000, which when you think about the number of jobs lost in a week, 800,000 jobs in a week, we were doing, far below that, 100,000 jobs, even during bad times, or 200,000 during the worst of the 2008 and 9 recession. So, we're seeing the economy in a situation where it's still shedding jobs at a very, very alarming rate. And all of that, I think, has made everybody very, very concerned. And the Fed chairman said this week that he really wants Congress to come up with another stimulus package. The old package was done last April. It's getting a little long in the tooth. We need more support out there in the economy. I think the Fed chairman was clearly signaling that to Congress. But as we all know, it's become a political football at this point, and we're just not seeing anything done. And I think although most analysts had built in the assumption that something was going to get done in terms of additional stimulus, I think the likelihood of it diminishes each day. And certainly the closer we get to the election, the likelihood, I think, it gets further and further pushed back. I included this slide because everyone wants to know, how long is everything going to last? When are things going to get better? And that's really the loaded question. At Cox Automotive, we don't do economic forecasting. We don't predict long-term forecasts out there, but there are many places that do. And one that we follow quite closely is Moody's Analytics. And I'm just showing here what their most recent forecast is of what's going to happen to the unemployment rate here over the next couple of years. And I think this just kind of summarizes the general idea of how this economy gets back on track. And essentially what you can see is that we had the big spike during the worst of the pandemic, but we're now starting to see things come back down. But it's going to be a very slow recovery. And that even from what Moody's is forecasting currently, they're talking about the end of 2023 before we see the unemployment rate get back to sort of near pre-COVID levels. So we're looking at another good solid 3, possibly 4 years till we're going to start to see things get better. So I think we all need, or at least back to where we were before. Let's put it that way. Certainly things are better. So I think we need to start setting our own expectations and being prepared for that this is going to be a bit of a long haul. The other thing we watch closely is what are we seeing from consumers. We monitor Morning Consult, who talks to thousands of people every day about what they see in the economy. You can see that their latest measure that we've got from them has consumer confidence back up above 91. It bottomed out at 81 at the beginning of April. So we are seeing consumers out there and the sentiment in the economy starting to improve. It's definitely better than where it was. But as I said, it's been very, very slow going. There was no V-shape in terms of people's views about the economy and this virus. It's going to take a while to rebuild that confidence level within the population. And so that's going to mean that's why we all have to kind of get readjusted to this new 80% economy. I think that's going to be one of the hot terms you're going to be hearing about over the next few months, that the new normal is going to be one where we have to reset the size of what we're going to have out here as long as that virus is around. So let's take a quick look at some of the surveys that we've done and what we're seeing out there from shoppers. And one of the things we do at Cox Automotive is that we talk to thousands of customers as well as dealers on either through our website shopping analytics or through surveys that we do for many of our dealer sentiment surveys and other things. But we're always trying to capture what is the view out there in the marketplace from automotive market participants. And so one of these, I just pulled out a couple of these slides because I think these are the most interesting. But one of them we asked them about is, what are you most concerned about? You know, are you concerned about this virus, and how concerned are you about this virus? And you can see that people's views about this virus from when it started in early March to where it is today, that's where it is here on the left. You can see about 57% of folks were very, very concerned about the virus at the very early onset. That peaked a few weeks later at 71%, and it's been drifting down essentially since then, and now we're back down to 57%. So folks are concerned. They're certainly worried about the virus, but it is starting to get a little bit better from where we were just a few months ago. And what you can see at the other end, though, is not concerned at all about the virus. That's now up to 18%. That's a high. We haven't even seen that level before. So, you know, the country is essentially moving to this world where we are getting more accustomed to this virus. But there is a sizable portion of the population out there that's still very, very worried about it. And so I do suggest to all of you out there, as you're running your businesses, keep that in mind, that your customer coming in is, you know, it's better to err on the side of caution, stick to protocols, make those customers feel comfortable when they come in, because certainly there's still lots of folks out there that are still quite worried about this virus. And if we also ask folks, what are they most concerned about? And I thought this was kind of interesting. You can see here on the right that at early March there, 71% of folks were most concerned about the pandemic and everything that was going on with the virus. That has since fallen to 49%. And you can see that over the course of the summer months and then recently, this presidential election that's approaching is becoming more and more of a concern for folks out there. And I'm sure we're all well aware that that election is coming up, and I've got a few slides on that at the very end just to talk a bit about that. The other thing we're talking about is folks visiting the dealership. Are they likely to visit the dealership, or are they going to be kind of scared away because of this pandemic? And in the early days of this crisis, we can see that 41% of respondents were saying that they were much less likely to visit the dealership because of the pandemic. In the early days then of April and May, we saw that this peaked out at 60% of respondents saying that they were not going to visit the dealer, or they were very concerned about visiting the dealership. But that's since improved as well. And now we're back down to essentially where we were in the early days of the pandemic, with just 43% of folks saying that. So again, as I said earlier, I think we have to be well aware that the customers out there have expectations now, or they expect to go into dealerships, and that they are expecting that everyone is doing protocol so that we can all be safe out there. So I think that's something that everybody at this point is building into their own business models. And we have already seen that we did talk to dealers, and 93% of dealers say they are encouraging a social distancing policy at their dealership. And I think that's just smart, given the size of the population out there that's still very, very worried about this virus, and rightfully so. So what does all this mean in terms of consumers and their willingness to buy? Well, we do see that the virus is holding back folks, but not quite as bad as what it was before. And we asked for folks that are in the market and going to buy, will you delay your vehicle purchase? And you can see that with this spiked in the early days of the pandemic of March and April at 34% of people saying they were going to delay, but it's been getting better every week since then, and most recently we're down to about 21%. So the virus is still having an impact on people's purchase intentions out there, but certainly it's starting to mitigate a bit, and I think that's something that we're just seeing in general, that more and more people are getting used to this virus and having to work with it and work around it, and so we are getting to a new normal, but as I said, it's going to be a new normal at a smaller economy, at an 80–85% level than where we were before. And we asked folks, what's the top reasons for your delaying purchases? Well, they're concerned about their financial situation. They're concerned about having contact with people. They're concerned about the need for it anymore because they're just not driving as much. All of these things. But clearly we can see that stated a couple of times in here is folks' concerns just interacting with people and virus related. So, there's not a lot you can do about people's financial situations, but certainly you can continue to provide a safe purchase environment and a safe business environment for them when they do come in. And then we also asked, how many folks are looking to be purchasing a vehicle in market in the next 6 months? This is one of the bad numbers that we are seeing out there. About 20% of folks in the early days of the pandemic were saying that they were going to purchase a vehicle within the next 6 months. That's now fallen to 14%. So we are starting to see that this virus and the economic situation is moving vehicles a little bit off of the front burner in terms of people wanting to go out there and buy. I would also suggest another contributing factor is the financial stimulus that we got from the government, the unemployment benefits extension and the extra money that many folks were getting. All of that helped stimulate a lot of extra activity that has been diminishing through time. And certainly that's behind the scenes as we look at all of this. And then lastly, on some of the surveys that we did, in terms of fixed ops, we asked folks, are you delaying any kind of vehicle servicing or repairs? We can see that in the early days of the pandemic, this spiked at about 36% of our respondents saying that, yeah, they were going to delay and not get things fixed right now. But you can see that, too, has been improving. But it still remains relatively elevated, with 21% of folks saying that they still are going to delay. Again, you can't do anything about their own personal reasons for not wanting to fix their vehicle, but certainly providing a safe environment to do it will help. And then the last one I just wanted to show you in terms of surveys, because I think this is kind of interesting. The Federal Reserve Bank actually does a survey of loan officers around the country, and they ask them a survey as to whether they are, whether their bank is tightening standards for the auto loans that they provide, and it's a yes/no question. And then they ask them what percentage of, or what if your bank is seeing a stronger demand for auto loans. And what we can see in red there is the number of banks that are saying, yes, we are tightening our auto loans has really made a huge spike over the most recent data points here. And so we are starting to see that credit is likely to tighten a little bit out there in the marketplace, as banks are saying we're going to be looking for even tighter standards, better FICO scores from people before making a loan. And then coupled with that, from the consumer side of things, that blue line, banks are saying, no, we aren't seeing a stronger demand for auto loans. So we're kind of coming into a double whammy here, where it's going to be more difficult to get a loan, and fewer people even want that loan if they get approved. So, this is why we have a lot of concerns going into this fourth quarter. So let's talk about what we're seeing in the new vehicle market and what's happening right now. We just finished the month of September, and I think everybody was pleasantly surprised at how strong new vehicle sales came in. We finished at a seasonally adjusted rate of 16.3 million. That's sort of back to numbers that we used to see just last year. So I think everyone was really pleased to see that number again. But I will say it was a little bit of a surprise because we don't see in our own metrics, we don't see that level of strength out there. And we think, there was probably some issues related to sort of the whole month of September and August and the Labor Day holiday spilling over and the 2 additional selling days within September. When you look at the calendar and you're tracking sales, it was a bit of an oddball month. So, we'll hope it's not an anomaly, but we do think that maybe it was a little bit higher than maybe what it truly is. But what we are seeing is that, vehicle sales for the month of September were down about 4.3%. Year to date, the industry overall is down about 19%. But car sales are down substantially more. They're down year to date almost 32%, while light trucks are down just a little under 14%. And one of the things that we've seen during the pandemic is that car share has progressively been getting worse as folks are more and more reluctant to buy cars versus these trucks, as well as the fact that there's just not as many car products out there to buy. But I think the fact that the industry has so few of these car products now does suggest that it may be more of a challenge to get back to our 17 million annual levels just because there's just not as many cars out there, and those products are some of the more inexpensive ones out there in the market. But the other thing that's interesting is what's selling out there in the market, what channels are doing well. And we look at the retail channel where consumers are buying a vehicle. We also look at leasing where consumers are leasing a vehicle. And then there's the fleet side of the business where you have the rental car companies as well as commercial fleet and other types of fleet activity. And what I'm showing you here is the monthly annual change year over year that we saw in these different channels. There is a little bit of a delay in getting this data, so the most recent data I have is only through June. But it really kind of does tell the story, which is we can see that we started the year on fairly strong ground for all of these different channels, and then once the pandemic hit, everything started to fall. But we can see the rental car business fell almost 90% on a year-over-year basis. It's now starting to improve a bit, but it's still down, at least through the first half of this year, it was down about 54% year to date. While on the other end of the spectrum, you have the retail side of the business, folks like you and I, or consumers out there, would go out there and actually buy a vehicle with a loan or cash. That was only down 13%. And we can see leasing activity overall for the year is down about 26%, and then commercial fleet down about 28%. But it's just interesting to note that the different channels are not all performing the same. And that I think it has been surprising that the retail channel has held up as well as it has. And I think that certainly adds to the strength of the consumer base of new vehicles, that we have the 6-figure income buyer is essentially the new vehicle buyer, and they haven't been hit as hard by this pandemic and the job losses that we've had. And I think that's one of the reasons that the automotive industry has held up as well as it has so far. On the other end, though, we have fleet activity, and I think it seems very unlikely that we're going to see certainly rental car fleet activity make substantial gains until we get through sort of the worst of this business travel crisis and the COVID-induced pullback in that type of travel out there. So we don't expect fleet activity to really make an improvement until around 2022. But that's going to be suppressing the overall market as well. When we look at year-to-date sales, as I think I've shown you many times before, sort of the geography of how states opening and closing during the worst of the pandemic has really impacted year-to-date numbers. So I think we do need to be not too judgmental on these companies looking at the year-to-date sales, because many of the moving parts have been entirely out of their control with governors shutting down states in various parts of the country. But if we look at year-to-date performance so far, overall the market's down 19%, but clearly sub-brands are down substantially more than that. And I think we can look at the types of products that companies have, as well as whether they're heavily into the fleet channel. I think these things have really been dramatically impacting sales performance year to date. Certainly Dodge and Nissan do a lot of fleet activity. They've been negatively impacted by the pullback in fleet. And certainly at the other end of the spectrum, Tesla, with their direct-to-consumer business, probably wasn't as impacted by all of the dealership closures out there. So they were able to kind of keep humming along, even all the other companies were having some distribution problems. And as well as you can look at the Koreans, I think they're probably the best example of having a good product portfolio, They've gotten heavy into some of these new big crossover vehicles, and certainly I think that's been successful for them, certainly looking at a year-over-year comparison basis. So that's what we're seeing for the different brands, but what's also interesting is when we look at the different segments, we can also see some interesting trends that are emerging. Certainly overall, as I said, the nation's down about 19%, but if we look on the far left, we can see some vehicle segments are down substantially more. But in all of them, I think you'll see, or the vast majority, have the word car in them. And I think this, again, we're just seeing that at this point in time with this pandemic and the consumer base that's been hit as a result of this pandemic through the economy and geography and all the other moving parts, those car buyers appear to be the ones that have been hit substantially more than your other crossover or truck drivers. And so we can see full-size car, subcompact car, down. And I think subcompact car and compact car in particular are kind of interesting that they're down so much more than the national average, because these are two of the lowest priced vehicle segments that we have in the market. And yet they're performing much worse than the national average. It's a little bit counterintuitive. You would think that folks would be looking for ways to save money, looking for the best value they can find. And what we're seeing is that they're deciding that value is not being found in the new car segment. And I would suggest, I think one of the things that we're seeing emerging from this pandemic is that low-priced vehicle segment has lost a lot of business to the used car segment. And I think we're seeing that a lot of folks that would have normally bought in the new side have opted to take advantage to the whole slew of products that you can choose from in the used car market, of those gently used. Certainly a lot more options to choose from, particularly if I'm looking to get a crossover vehicle. So we have that going on. But one of the things that we think has really had a big impact on sort of the initial stages of this pandemic and the market recovery was the fact that the industry went heavy into 0% financing. And this is showing the share of contracts out there, vehicle purchases, where folks paid a 0% interest rate on the contract. And you can see that in April and May, it really spiked and started coming down. And we see in the early days of October, it surged a little bit again, but it's early days, so that'll likely come down. But it still remains well above sort of the previous, pre-pandemic levels. So the industry has been very aggressive at doing interest rate subvention, and I think it makes sense because it's certainly a way to take advantage of a lot of the interest rate cuts that the Federal Reserve has enacted. But what we're seeing out there is that this strategy is continuing, but it may not have as much impact as it had initially, because the customers out there who can qualify for these low interest rates are probably getting smaller and smaller, or fewer and far between. But this is a chart that I think is kind of interesting. It's showing by month on the left here the share of the nation of vehicle purchases out there, what interest rates that they're paying. So we can see here the share of the market out there that's paying less than a 2% interest rate on their purchase. Well, in the month of September, it was about 25% of the market was paying less than a 2% interest rate. And we had about 26% was paying an interest rate of 2 to 4%. And at the other end of the spectrum, we have somewhere in the neighborhood about 3% of the market that's paying a 15% interest rate plus. And it's that high interest rate, those folks that are paying 10% plus on that interest rate, and when you add it up, it's about 10% of the market. Those are the folks that have probably been in the crosshairs of this virus and the job losses out there. Because if you're paying a high interest rate, you're probably a low FICO score customer, and that would suggest that you're probably a lower income and or an hourly worker. And so that's something that I think is kind of interesting, because it does have implications for the types of products that could be impacted and the companies that might be impacted. And what I'm showing you here, this is showing the average interest rate that we have year to date for folks that bought these different products. What was their contracted interest rate? And what we can see here is that subcompact car, the average interest rate is close to 10% for folks that are actually buying that vehicle. That would suggest that these are low FICO score customers. And again, I don't have the exact match, but I'm postulating that these are your folks that your hourly workers or your slightly lower incomes. They're probably more vulnerable for the job losses that we've had so far during this pandemic. And that may explain many of the declines that we've seen in some compact car sales. And if we look across the spectrum here, we can see that there's quite a few of these car segments that, just as we saw year-to-date sales were down substantially more, we can also see that the average interest rate for these car segments is much higher as well. And at the other end of the spectrum, we can see that the luxury car segments, the people who are buying those products are the best credit customers out there. They're able to qualify for those low interest rates. So they must have high FICO scores. Given the environment we're in, it may be that the luxury buyer may be a little bit more insulated or have a little bit less risk than the lower income folks out there, because it does appear that the stock market has come back fairly well. The housing market appears to be coming back fairly well. All of that, as well as six-figure income job losses, for the most part, have remained fairly mild. All of that would suggest that the luxury car buyer in general has held up fairly well and may continue to do so here, at least through the fourth quarter and certainly into 2021 as well. And then just looking at this, just to kind of reiterate the point, just looking at the share of the market for these different products, of who's paying a subvention interest rate and what share of the customers are paying these exorbitant double-digit interest rates, you can see that, again, these car segments, huge portions of their customer base are paying these very high interest rates. And again, at the luxury side, huge portion are going to get the very best interest rates. And then just looking at the different manufacturers, again, very, very similar story, but we can see Mitsubishi, Dodge, Nissan, their customers are paying some of the highest interest rates out there in the market. Again, that makes them very, very vulnerable to any kind of interest rate changes, as well as the job losses that we've seen out there. And then at the other end of the spectrum, you can see Land Rover, Subaru, Jaguar. Their customers are paying some of the best interest rates out there. So if we had to look at brands that may be vulnerable and what brands may be not as vulnerable, as this recession gets progressively worse, if it does, it would suggest that some of the higher FICO score brands may be in a little bit more vulnerable than some of the other ones, because of their natural customer base is probably going to suffer a little bit more as a result of a worsening recession. And again, just to kind of look at the different brands out here, I do think it's kind of interesting that in our data, nearly 60% of Mitsubishi's customers are paying a 10% interest rate or higher. And at the other end of the spectrum, you have Subaru, Land Rover. They're in the neighborhood of 60 to 70% of their customers are paying less than a 2% interest rate. So really quite a variation out there when you look at the different manufacturers and brands. But the other hurdle we still see is still this inventory hurdle. And just looking at new vehicle inventory, we see it still tightening out there. But I do think we're going to start to see in coming weeks that the inventory situation is going to get a bit better, because we do see that there is starting to be more of these model year 2021s that are being shipped out. But when we look at available supply this week, it continues to be tight, and even more important is sort of that days of supply, how much inventory, based on recent sales, how long will the existing inventory you have last. And at this point, we're looking somewhere in the neighborhood of about 56, 57 days. You can see that's down to lower than levels that we were at last year, but it's stabilizing a bit. It's getting a little bit tighter, but certainly we're not seeing anything dramatically shift regarding the inventory situation. But as I did mention, we are starting to see more of the next model year vehicles come in. This chart, I think, is kind of interesting because the dotted line is looking at the inventory share of products last year, and then the solid line is the inventory's product share this year. And the dotted blue one is really the most interesting one, that at this point last year, almost 32% of inventory at dealerships around the country was model year 2020. Currently, in our data, we're showing that only about 8% of inventories today is model year 2021. So a lot more old product exists out there because of all the delays with during the COVID and the factory shutting down, as well as the strategic planning guys up in the offices being shut down as well for a period of time. All of it's caused a delay on the model year rollover. But as I said, we are starting to see more and more of this new product inventory get out there. So I think this situation will start to improve in coming weeks. But we look at inventory levels for the different brands. We can still see on the left here that Toyota and Subaru still appear to have some of the tightest inventories out there, well below the national average, with Fiat, Mitsubishi, and FCA in general at the other end of the spectrum. And as I said, we talk about the model year rollovers. There's still some model year 2019s that some manufacturers have. That's what's in blue there. And then there's what share of their inventory is the model year 2021. That's in green. Well, you can see some manufacturers have been much more aggressive about getting the new product out there. Certainly Hyundai and Kia and Toyota have some new products out there. But as I said, I think we're going to start to see more and more green here when we meet again here in November if we do this again. And just looking at the luxury side, we can see here on the left that Lexus and BMW continue to appear to have the tightest inventory out there, while Lincoln and Buick have the most. But when we look at the model year rollover and who's got new products out there, we can see that there's not a lot of green. So we're not measuring in our data a whole lot of model year 2021s in the market just yet for the luxury side. Again, I think that is going to change though in coming weeks. But we also see quite a bit of blue, and that's showing the percentage of inventory that's model year 2019. And you can see that some manufacturers still have quite a bit of that very, very old product out there. And that's something that they're going to have to deal with. So let's finish up by talking about the used market. It certainly has been a very, very volatile market over the course of this summer. And we heard anecdotally from a lot of dealers that they were having the best summers ever in terms of vehicle sales and the profitability that they were able to achieve on many of their used products. It's really been quite phenomenal. And I'll show you a few slides on some of the massive changes that we've seen. But I will say, I think we are going to start to see this moderate a bit over in the next coming weeks. And hopefully the profits all remain very, very strong. But my sense is that we may sort of we've moved past sort of the hotness of the market, and we're starting to settle down now into a more mundane reality. But just looking here, rolling 30-day sales here on the left, we can see a nice V-shaped recovery in the used vehicle market. But you can see that since the early part of summer, it started coming down, and now 30-day sales are really kind of back down to earth from where they were before. And you can see on the right here, this is showing the year-over-year change, and in orange is showing the change we had versus a year ago, and in blue it's versus a week ago. And really the orange one's the key, that we saw the huge comeback and the year-over-year sales actually were positive for a period of time, but now they've slipped into negative territory, and we're hovering somewhere in the neighborhood of around down about 5 to 10% on the used vehicle market at this point in time. But the thing we're concerned about is supply, and whether supply is going to constrain this market. And what we can see here on the left, this is available supply that we have measured out there, and you can see that it fell dramatically until the beginning of July, and then it started to make a bit of an improvement. And part of that, I think, was the pullback that we saw in vehicle sales. Sales weren't quite as hot as they were before, as well as a little bit more activity on the new vehicle side, so there was more trade-ins coming to market, as well as off-lease, and all of these things helped provide a little bit more inventory to the used market. But if we still look on the right here, on the left, that orange line still shows that inventory levels are far below where we were at a year ago, down somewhere in the neighborhood of 15 to 20%. So in the used market, the inventory side still looks to be fairly tight, but it's not getting any worse. And so when we look at the day supply, that's what over here on the left, we can see that there's really been a lot of volatility in the used market. And that really happened because we saw these dealers having to shut down during March and early April. It really stopped sort of vehicle sales, and we saw day supply really spike because there was all this inventory and no sales, so the calculation hit a peak. But once we saw the stores reopen, the sales started to occur, the day supply has come down, and you can see it sort of bottom, and it's now starting to creep up again, and now we're sort of hovering at this new level or this new normal of around 40 days supply or so. And as you can see on the right, this is down somewhere in the neighborhood of 10 to 20% from the supply levels we were at last year. So there really is this theme where the economy is sort of down in the neighborhood of 15 to 20%. We're seeing supplies down in that neighborhood, and we are starting to see vehicle sales starting to settle down at a lower selling rate. All of these things are, we've had a huge shock to the economy, and everything is going to take some time to readjust, and that's kind of what we're seeing out there today. The other interesting thing out there is what we're seeing at auction, and this is a slide that's showing a model year 2017 vehicle, what its retail price in blue and what its wholesale price would be of what it would cost at auction. And what's really interesting to see here is you can see the auction price has really been particularly volatile. That's what it's got here in gray. And that we can see that in the early days of the pandemic, when the auctions were shut down, there was all this concern that there was all this inventory out there. Everybody, let's get rid of our inventory. No one's going to want these vehicles. We saw values at auction just plummet. But then we saw that that was really kind of a false assumption that these vehicles were going to start to sell. You can see that it quickly reversed, and we now see that wholesale prices were really rising much more rapidly, even more than retail prices. And that was really creating that strong profit margin that we saw for dealers over the course of the summer. But you can see now the gray and blue lines are starting to get a little bit closer together. And in fact, the gray line has started to turn. We expect that the blue line is also going to start to turn here in coming weeks. But all of this suggests that we did have a very hot period in the used market, but things are suggesting that it's going to change here in the next coming weeks. So lastly, I know we got the election coming up, and I didn't want to leave without just saying a couple things about it, because it really is going to have huge ramifications for the vehicle market. And I won't get into the politics of who wins and loses, but I just want to talk a bit about consumer sentiment and the fact that the importance of consumer sentiment to the economy, but in particular to vehicle sales. And what I'm showing you here in orange is the 12-month moving average of the University of Michigan's Consumer Sentiment Index. And I've overlaid it with the 12-month moving average of the light vehicle sales SAAR. And this is going back about 40 years worth of data, of monthly data. And you can see there appears to be a very nice correlation between that orange and that blue line. And that makes sense, right? That we would expect that if the more confidence I have, the more willingness I have to take out a big car loan and to make that big, expensive vehicle purchase. When I'm not confident on my situation, I'm going to pull back from the market. I'm not going to make that vehicle purchase. And we can see that these two lines have a very nice correlation between them. We can see that in the early 2000s, we had a divergence between these two lines. When the orange line fell dramatically in the early 2000s, as we had, the post-dot-com bubble bursting, and we had a mild recession in 2001, and of course we had the 9/11 attacks. All of these things had a huge impact on consumer confidence, yet we can see vehicle sales kept humming along. And that was that period where the industry wanted to keep vehicle sales going because they had these long-term labor agreements with the UAW. So it was better to sell that vehicle at a loss and just discount it than it was to not build the vehicle and still pay the wages. And so we inflated the market for a period of time until the Great Recession hit, and both consumer confidence and vehicle sales fell. And then we had this recovery period starting in 2010. That blue line just shot right up, and that's where we saw vehicle sales really take off over the last 10 years. You can see consumer confidence didn't quite follow the same trajectory. And in fact, you could argue that consumer sentiment became a little bit less strongly correlated with vehicle sales during this period because they didn't rise at the same rate. And I think this kind of illustrates that maybe since the Great Recession, the consumer sentiment in the vehicle market kind of went different trajectories, that the vehicle market doesn't kind of represent as broad a measure like the consumer sentiment index is. It's not quite as broad a measure because only very wealthy people are buying new vehicles. And so we can see it's a little bit of a difference. But I take you through this because what we have is this election coming up. Oh, and I should just finish that. And you can see that the most recent data points of these both show the huge decline as we enter into the pandemic, having a huge impact on sentiment as well as vehicle sales. But I mention this because we have this election coming up, and consumer sentiment is just an average of our whole country. And half the country thinks the glass is half full, and half the country thinks the glass is half empty, and together we have this average of consumer sentiment. And that's what that green line is here. And this is the University of Michigan's Consumer Sentiment Index, and they actually ask, what is your political affiliation? So we can look at the data to know, how do Republicans feel, how do Democrats feel. And I just wanted to point out that if we look at the green and the red line and the blue lines here at the top of this page, this is going back during the Obama administration and then when the Trump administration, and that we can see that in the early 2000s, 2007, 2008, the red line was above the blue line, and that's when we had the Bush administration. And once Obama was elected, almost overnight, the blue line rose to the top as Democrats became much more optimistic The red line falls because Republicans became much more pessimistic as a result of Obama being elected. Yet you can see the overall green line just changed a little bit. It didn't change a lot, but underneath the hood, who was happy and who was sad changed dramatically. And that happened all through the Obama administration. And then Trump was elected, and we can see the red line just went through the roof practically, and the blue line fell dramatically. And yet the green line, the average of everybody, is essentially unchanged or just remained fairly stable. So if we know that consumer sentiment has a dramatic impact on vehicle purchases, and if we accept that that there is a divide in this country, well, depending on who wins this election, people may want to enter the market or may want to pull back from the market, depending on how the election comes out. And so it could be that in red states and some product segments like pickup trucks, they may be a little bit more vulnerable because we know that they are a hot product, in particular in red-oriented states. And if we look at blue states, we know that cars in general or more fuel-efficient vehicles are generally a little bit more attractive. We do see a little bit more luxury activity, particularly on the East Coast. And of course, alternatives are probably a little bit more favorable in a blue state environment where those natural buyers, or if Joe Biden wins, will all of a sudden become much more optimistic than they are today. The reason why I think this is kind of important is because the gap, and that's what I've highlighted in red here in purple, the gap between the political parties has never been this large, at least not from what the University of Michigan has measured before. And so that gap, depending on how this election unfolds, could change dramatically. And that may be, we may not capture it sort of looking at the aggregate, but as we know, under the hood, the customer base out there is going to change dramatically. And so I just suggest that to you, that as you think of your customers and the products that they're going to be interested in, we may find that some products are going to become of more interest to some customers in the wake of this election, and some products of less interest, just because they now see the glass as half full from where they just saw it just a few weeks before. So with that, that's my presentation for this month. I don't see any questions here, but if anybody would like to shoot me a question, I'd be happy to address those and answer anything that you may have, anything you want to ask about.
Charlie, thanks for always keeping us updated. I think this information is great and really important to get out, which is why we have you coming back each month. Again, to those on the line, you'll be receiving a copy of this webinar by the end of next week.